If you had invested £1,000 into the S&P 500 10 years ago and completely ignored it, you'd have more than doubled your money. No trading, no stock picking, no watching the news, just patience. Here's exactly what would have happened and why this matters if you're investing today. Let's rewind to early 2016. You invest £1,000 into a simple S&P 500 index fund. That index tracks 500 of the largest companies in the United States, businesses like Apple, Microsoft, Amazon, and hundreds more. Instead of betting on one company, you own a piece of all of them. Now, here's the important part. Over the past 10 years, the S&P 500 has returned roughly 10% per year on average, including dividends. Some years were negative, some years were huge, but long-term, that's been the range. So what does that mean for your £1,000? After 10 years of compounding at around 10% per year, your investment would likely be worth somewhere between £2,500 and £2,800. And that's without adding another penny. You didn't time the market. You didn't panic sell during crashes. You didn't jump between stocks. You just stayed invested. Now let's talk about what nearly stopped that from happening. During the pandemic in 2020, markets fell sharply in a matter of weeks. Headlines were terrifying. Investors panicked. Many sold. If you had sold during that crash, your long-term result would look very different. But if you stayed invested, the market recovered and then went on to reach new highs. This is the difference between investors who build wealth and investors who constantly restart. Compounding only works if you stay in the game. And here's where it gets more powerful. What if instead of investing £1,000 once, you invested £100 every month for 10 years? At similar average returns, you could be looking at around £20,000 or more by the end of that period. That's not luck. That's consistency plus time. Compounding is slow at first. In the early years, growth feels small, almost boring. But later, growth starts building on growth. Your returns start earning returns. That's when the snowball effect becomes real. Now, a reality check. The S&P 500 does not guarantee 10% every year. Future returns could be lower. Markets can stay flat for periods of time. But historically, broad index investing over long time frames has rewarded patient investors. And if you're investing from the UK, this can be done through a low-cost S&P 500 ETF inside a stocks and shares ISA, meaning your gains can grow tax-free. Simple, diversified, low cost. The lesson here isn't that £1,000 makes you rich. It's that starting early multiplies your options. 10 years feels long at the start. It feels short at the end. And the difference between investing and waiting often becomes thousands of pounds. The market doesn't reward intelligence as much as it rewards discipline. Start. Stay consistent. Ignore the noise. Let compounding do the heavy lifting. If you want more realistic, no-hype breakdowns like this, subscribe. We're not chasing trends. We're building long-term wealth.